All right, let's dive right into the Q2 2026 market numbers. On the surface, we're looking at these dazzling, headline-grabbing record highs. But as we're going to unpack in today's explainer, those surface-level numbers conceal a deeper, much more complex structural reality. It's a true paradox of prosperity, really. And to figure out where we're heading, we need to look past the ticker tape.
So, with the market soaring to totally unprecedented levels, a very natural question emerges. Is this all just a house of cards? You look at these sky-high valuations, and the immediate fear is, okay, we must be in a late 90s style tech bubble just waiting for the pin to drop. Or, is this actually built on bedrock?
To answer that, here is our agenda for today's explainer. 1. The record-breaking quarter. 2. Institutional power and independence. 3. AI, bubble or bargain. 4. The free cash flow illusion. 5. The K-shaped consumer economy. And finally 6. Q3 tailwinds and headwinds.
Section 1. The record-breaking quarter.
You literally can't analyze this market without acknowledging the historic momentum that absolutely defined the last 3 months. The Dow definitively broke above 52,000 for the first time in history, which was a huge milestone bolstered by Alphabet's official inclusion. Alongside that, the Nasdaq set a blistering 20% 3-month gain. That's its best quarterly performance since 2021. And what's driving the engine here? Well, it's largely driven by AI suppliers, which currently make up a staggering 75% of the S&P's Q2 earnings growth. Amazingly, we saw these gains even despite global geopolitical fragility and the Magnificent Seven temporarily dipping into correction territory. But here's the thing. The crucial point isn't just the stock price. It's this exact number, 14.8%. That is an all-time record net profit margin for the S&P 500. It smashes the previous 13.2% peak and is the highest we've seen since tracking began back in 2009. This 14.8%, that's the bedrock. It's bridging the gap between high valuations and underlying massive profitability, proving that companies aren't just growing top-line revenue, they're operating with historic efficiency.
Section 2. Institutional power and independence.
While the markets were busy surging, a massive structural shift occurred in Washington that secures the very foundation of our monetary policy. In a highly consequential split verdict, the Supreme Court completely shielded the Federal Reserve from executive interference. For example, officials like Governor Lisa Cook were explicitly protected from removal without due process. But, simultaneously, the court granted the presidency free rein to terminate officials at other independent agencies, like the FTC's Rebecca Slaughter, without cause, based on the separation of powers. Impartially speaking, this creates a really stark division in how federal agencies will operate going forward.
And this brilliantly illustrates the macro impact of that ruling. As Chief Economist Claudia Sahm points out, the fastest route to interfering with U.S. interest rates has effectively been closed off. By blocking removal without due process, the court has imparted a systemic reinforcement of the central bank's independence for the foreseeable future, which essentially provides markets with a massive dose of monetary stability.
Moving on to Section 3. AI, bubble or bargain.
Let's pivot to the $7.6 trillion question. With that level of expected investment build-out over the next 5 years, AI is undoubtedly the defining theme of the decade. But is it just a speculative mania? On one side, sure, you have the fear, sky-high valuations and concerns of a late 1990s tech bubble repeat. But on the other side, you have the reality check, that 14.8% net profit margin we just talked about. Wall Street bulls are finding comfort not in hype, but in unprecedented operational efficiency. That broad corporate profitability is acting as the fundamental, heavy scaffolding holding up these historic market highs.
This is where it gets really fascinating. When we check out 12-month forward PE ratios, we see an incredible paradox. Traditional, quote-unquote, boring consumer companies like Monster Beverage are currently trading near a 10-year high multiple, right around 40x. Meanwhile, the absolute darling of the AI revolution, NVIDIA, is trading at a 10-year low, sitting below 20x. It completely upends the narrative of a speculative tech mania.
And the strategy thesis from HSBC perfectly confirms this. They point out that earnings expectations aren't just empty hype. Realized earnings growth has actually vastly outstripped stock price performance. Think about that for a second. Trailing PE ratios for megacaps like Meta, Amazon, Microsoft, NVIDIA, Broadcom, and Micron have all actually fallen over the last 12 months. That is multiple compression in disguise, meaning their actual profits are growing faster than their stock prices are rising. This suggests a simple re-rating toward historical norms could drive the AI trade significantly higher.
Section 4. The free cash flow illusion.
But, the market is rarely perfect, and this prosperity definitely has a hidden vulnerability. It's specifically tucked inside the tens of billions of dollars currently flowing into free cash flow ETFs right now as traditional value investing underperforms. The major blind spot in the market is the failure to deduct share-based compensation, or SBC. We look at operating cash flow minus CapEx and we think, great, the company's healthy. But SBC is a massive warning sign. While it's technically a non-cash item on paper, it actively dilutes shareholders and secretly drains actual cash when companies are forced to execute open market buybacks just to offset all that stock issuance. It creates a highly dangerous illusion of corporate health.
When you run the numbers on real-world companies and strip away the SBC illusion, the fundamentals change drastically. For instance, Atlassian reports a 3.4% free cash flow yield, but after deducting SBC, it drops to near zero. Uber falls a full percentage point. And most alarmingly, giants like Amazon and Snowflake go from reporting positive yields to actually turning negative once you properly account for how much they compensate through shares.
Warren Buffett famously called this exact thing out years ago, asking, if compensation isn't an expense, what is it? It's a simple, undeniable logic. Ignoring this hidden dilution remains one of the greatest unpriced risks in the 2026 market, and it's artificially inflating the perceived safety of these highly valued tech giants.
Section 5. The K-shaped consumer economy. We see a very similar surface-level illusion when we step away from corporate balance sheets and examine the American consumer. The top-line retail numbers look fine, but underneath they hide a deeply bifurcated reality. It's a classic tale of two economies. On the top half of the K, you have immense upper-income resilience. Costco comparable sales remain highly robust, and AI-driven retail sales are expected to cross $2 trillion next year. Even Dollar Tree is benefiting from higher-income shoppers trading down to seek value. But the bottom half? They are facing a severe squeeze. Look at Constellation Brands. Sure, beer sales returned to growth driven by a Hispanic recovery for brands like Modelo, but their operating margins fell to 33.2% due to fixed costs and aluminum tariffs. Middle and lower income discretionary spending is just purely exhausted right now.
And honestly, this next stat is probably the most shocking part of the whole explainer. Over 3 million Americans aged 62 and older now owe federal student loans. That's up from 1.8 million in 2018. The demographic impact here is massive. They are facing skyrocketing delinquency rates that are actively forcing delayed retirements across the board. This is a fragile pillar of the consumer base literally buckling under the weight of sustained inflation and debt.
Section 6. Q3 Tailwinds and Headwinds.
As we move out of this historic quarter, we need to map out exactly what is going to drive the second half of the year. On the global macro stage, we're seeing three sequential steps play out. First, a diminishing geopolitical premium. The U.S.-Iran conflict previously swung oil prices by about $45 a barrel, but the Strait of Hormuz is actually reopening faster than expected, returning to pre-conflict norms of 30 to 40 outbound tankers. Second, this is creating a physical oil glut. High U.S. exports combined with low Chinese demand have led Morgan Stanley to cut their Brent crude forecast from $80 down to $75. And third, this environment is driving a structural currency shift. Because rate hike pricing is receding globally but remaining pretty steady here at home, HSBC is forecasting a structural U.S. dollar rally well into the first half of 2027.
So, bringing it all together, this leaves us with a perfectly organized mental map for Q3. On the macro and micro levels, we are looking at a massive tug-of-war. On one side, you have profound tailwinds, like the protected Federal Reserve independence securing monetary stability, structural U.S. dollar strength, and those record 14.8% profit margins acting as market scaffolding. But on the other side, they are fighting directly against severe headwinds, latent geopolitical fragility, persistent packaging inflation, the hidden free cash flow dilution of unchecked share-based compensation, and a really strained, bifurcated lower-income consumer.
Wall Street is still bullish for sure, but they clearly see diminishing returns ahead. As we watch the rest of this year unfold, the ultimate question really isn't whether the top-line indices can notch another record high. The real question we need to ask ourselves is this. In a market propped up by historic operational efficiency but actively undermined by hidden dilution, which side of this fractured K-shaped economic foundation will ultimately tip the scales for the rest of 2026? Think about how your own portfolio is positioned across that divide, because as we've seen today, the surface numbers just aren't telling the whole story anymore.